Yeah.
So good afternoon, everyone. Thank you very much for coming after lunch. How many of you want to double your portfolio in 2026? You're going to be totally disappointed. The answer to that question will not be provided on this panel. You know, when Shri suggested that I review this book, I was hesitating a little bit because it was 800 pages and there was not much left of 2025 to get through it with. But then I read the title which said Running Behind Lakshmi. And in my family, all my elder sisters and cousins are called Lakshmi. In fact, the running joke in the family is we have a treasure trove of multiple Ashtalakshmis in the family. So, and they were constantly bullying me, so I had to keep running, not behind them, but from them. So I thought I would jump upon the chance of running behind Lakshmi instead of running from Lakshmis in my family. And I'm glad I did, because this is an absolutely authoritative work on the Indian stock markets. For those of you who pride themselves that they know everything about the Indian stock markets, including myself before I started reading this book, I learnt a lot. I learnt a lot, not only in the sense that the Indian stock market goes back now almost 200 years, 185, 190 years. Stock market, now I'm going to put within quotation marks. Of course, formal stock exchanges came later, but the curbside trading, as you might call it, and we'll get Adil to speak about it in a minute, started in the early 1800s, and we can speak a bit about that. So first, I learned a lot about history that predated the history, if you will. So antiquity in the context of stock markets of India. The second is Adil does a fantastic job of laying down the people, the processes, the context of the stock market as it goes through its evolutionary period. And he has actually 4 periods that we will get to talk to. So another wonderful thing. And for those who may or may not care much about stock markets except for returns on stocks, the English is outstanding. It's a very rare combination of finance and English in one page. I actually had to look up the dictionary, a few words, and honestly answer to yourself, please don't raise your hands. Do you know the word panjandrum, denouement, handmaiden, portmanteau? And those are only 4 of the 25 words on which I had to look up the dictionary for. Maybe you know the word, but do you know how to use it in context? So for those of you who prefer the English side to the stock market side, please read the book for that. With that, I'm going to officially welcome Adil to the stage. He's done a fantastic job, and I'm going to begin, because once we get into the stock markets, we're going to have no chance to ask him about his journey and how he got to the book. So I'm going to reverse the usual order and ask him about how the book came about, and then we will dive into the content of the book. So Adil, may I ask you, how did the book come about? How long did it take you? Yeah. Describe some of the methods of research and tell us about the name.
Yeah. Nobody goes through life thinking they'll one day write a major work on a financial market. So this book sort of evolved from my previous actions. I had a small office in the Bombay Stock Exchange, doing what was called a PMS, advising people on equities. And one day, someone I think in the chairman's office told me that there were these archives on the BSc, not even in that swanky BSc building, but
just very close.
Can you hear me? Is that clear? Yeah. Not even in the swanky BSc building, but at Kama building, which was just next door, basically. And like all archives in India, they were molding. You know, in India, the monsoon is not conducive to paper and putting words on paper. The monsoon is a very powerful influence. So despite that, I sort of chanced on these archives, and I got fascinated with them. And I sort of I sort of got into it in great detail. And then I sort of made it my life work to, well, almost, to sort of tell the market story. Like most people, you among them, I just thought the market started in the early 90s. There was a person called Harshad Mehta, and there was a violent displacement and a move. And okay, it started a little before that. But then my grandparents' parents had shares. And then I vaguely remembered there was a company called Tisco, Tata Steel. And they had an IPO in 1907. So that means there was a market around that time. And then in the archives, I came across the work of this person, K.R.P. Shroff, who is the longest serving head of a stock exchange anywhere in the history of stock markets, anywhere in the world. He was its head for 43 years. And he wrote a small book which has disappeared, but there's a Xerox somewhere. So I read that, and then I realized this thing goes back really in time. And then in the 1860s, there's a violent displacement, a great turbulence, sort of sketchily mentioned here and there. So I came across that, and I realized that this was one of history's great financial manias. And no one had even known about it. Some of you will have heard of tulip mania in Holland. It was a noted period. And some of you will have heard of the South Sea bubble, England, again England, always the UK. But here was something that was okay, there's a guy called Crawford. You know Crawford Market in Bombay? Like you have Cubbon Park here, you have Crawford Market there. So there's somebody called Crawford who actually lived through this. And he made the casual remark somewhere that he was knowledgeable on history and all that this was bigger than tulip mania and the South Sea bubble. So that really got me started. Okay, how is this possible? There's this huge thing here and nobody's heard of it. So I looked into it in great detail. So now we are 1865. And now my curiosity gets piqued, and I'm like, where do we begin at the beginning, right? So you have to keep going back. And then in 1829, you chance across a Union Bank IPO, not this Union Bank, another one, which is much larger than even Tata Steel's IPO. And in fact, I'm a little conservative, and I took a 3% interest rate. Over long periods of time, minor changes in interest rate matter a lot to the end figure over here, right at the end. And even at a conservative 3% rate, the Union Bank IPO is a lot bigger than Tisco. So that's 1829. And then you go to the beginning, and then you realize that, well, there are no courts. But luckily for us, the early newspapers functioned as pink sheets, like NASDAQ pink sheets. You know NASDAQ, it's a huge stock market, mainly for IT, so you're familiar with that. NASDAQ now has dealers, level 1, level 2, level 3 dealer. It's a dealer-driven market. But NASDAQ started off as pink sheets, where dealers put buy-sell quotes for stocks on pink papers and distributed it. So like that, the early newspapers in India almost functioned as NASDAQ pink sheets. So you get in Calcutta and Bombay, these early newspapers, where you get these quotes for stocks. Now, the first newspaper in India is Hickey's Bengal Gazette, and I've looked at those issues, 1780 to 82, but there are no stock quotes. But following that, there's a Bengal Hurkuru and Chronicle, which is India's second paper, started 1795. And over there, in those issues, you get quotations for stocks. So we are talking, the earliest I've seen is 1805. So, but for debt paper. Bengal government, East India Company debt paper at coupons of 4 to 5%. So those are the earlier, and then from the 1820s, you start getting quotes, Agra Bank, Union Bank, Kolaba Press, Akbar Press. These are the names, basically. So we are talking about what is the world's oldest emerging market. So effectively, India is the world's oldest emerging market, but no one really knew about it. That's what it looks like. Poland is a little older. Poland ended with communism, but the original Polish market may be older, but there are questions about whether Poland's an emerging market at all. It's an OECD market, it's Europe. And then the Balsas in Latin America, Brazil and Argentina predate the BSE. But for informal street trading in India predates them. So my sense is you're talking about the world's oldest emerging market, and it's definitely over 2 centuries old. And now we know about it, and the story's in the public domain.
So, the name?
The name came subconsciously in a flash. I don't know how it came. But there is a lobby at the BSC, and there's a likeness, Lakshmi, and traders prostrate before the likeness for luck, and then they go on to their trading rooms. And I used to see this every day. And I realized that these people, everybody's running behind Lakshmi. And they are not running after. Because running after implies you can catch up. But running behind implies you can never catch up. And that's because the greed, the greed in human nature, it's never enough. Whatever you do is never enough. So I debated whether it is running after, which is actually grammatically better, if you ask me. But running behind, I thought, symbolized the ant heap, the human nature and emotion and effort, and it just goes on. And it's never enough. It's never enough. Because greed, human nature is like that. And I've experienced it personally, but fear, greed, and regret tend to be the emotions that drive markets. So that's why it was behind.
So let's now delve a little bit into the book. You describe India's stock market in 4 broad phases. The pioneering early decades, sort of what you just heard now, going back to the early 1800s, perhaps going up to 1900, maybe late 1800s. And then a very interesting phrase that you use, a century of marking time. And then much more the modern era that you and I would recognize, a reform era phase. And then the post-reform SIP phase, as he calls it. So do you want to just briefly touch on these 4 phrases? I think it's a useful framework to think about the Indian market evolution in those 4 bits. So please.
Yeah. Well, these phrases did not exist. I had to invent them for this because there's not much on the market for such an important process. You see it from 9 to 3:30 every day, like Toys R Us, its markets are us, and yet not much known about it. But these 4 phases, like Ireland has a time of troubles, and Japan has a Meiji restoration. I was like, there's no phrase to describe this massive process for a country which now is finding its place in the world. India is expanding. So I gave these phrases, the century of marking time. It seemed okay. The essential methodological problem here is the command over history as a subject and the financial markets. So you need to have some knowledge of both, and you need to, history, the subject behind the subject is something called historiography. So the methodological intellectual challenge is applying that historiography to financial markets, which are essentially random, and that's narrative. So you have to, historiography, I don't have formal training in it, so I had to cultivate it with people who were very knowledgeable about it. You need to know historiography because it helps you, it gives you a command over primary and secondary sources. So that basic primary, secondary distinction and how to handle sources, that is very critical. That comes from this. Also, historiography gives you a frame of mind, a certain mindfulness in which there is first of all a concern for the turning point, because there are 200 years of effort. So you don't want to focus on anything, you want to look at the turning point in this period. which allows you to arrive at these avenues, these breakages. Then you need a concern for cause and effect over time, which is very difficult. And now it comes intuitively to me because of command over the sources, but otherwise it's a very difficult process, untangling cause and effect over time. So that is important. Then you need an eye for change and continuity. That is also very critical. And finally, you need an eye for those events of the past that explain the present. Because there are so many events happening, you have to have a bias for those events of the past. Like Badla, the short side is gone. Because in 2001, they abolished Badla, which had a fluent short side. So those events of the past that explain the present are vital. And then you need a sense of empathy or sympathy for these people. Because that is, you have to look at the past through its own eyes and not your eyes. This is very critical. It's very difficult in India. It doesn't happen off easily. But the past has to be looked at through its own eyes and not your eyes. So there is a lot which is very strange about that and absurd and primitive. But still it has to be looked at through its eyes and not yours. That's called presentism. Presentism is the issue here. And it's an issue in this country. Presentism is an issue. So all these things combine. A Dalrymple or a Manu Pillai, you know them, this sort of attitude comes naturally to them. But it did not come so easily to me because my training's in markets and all that. So this is how the historian's mindset works, a certain mindfulness. But those guys are what you call battles and kings historians. You know, battles and kings, they are rajas and this, that. But our subject is financial markets, so it's pretty detailed. So then you have to apply the sort of Dalrymple Pillai approach and the mindfulness to financial markets and this subject. And I thought I knew a lot about this. I found I knew nothing till I put my pen on paper. So the NSE subject chapter, for example, deals with a subject called market microstructure. You know the nitty-gritty of plumbing and rules behind the flickering prices that all of you see. That's microstructure. Now the FII chapter deals with open economy macroeconomics, so this is micro, that is macro. It's an opposite field, especially with the rupee. You know the rupee and it deals with portfolio flows coming in and out. That's the subject. Then your speculation investment chapter deals with investment policy, which is a basic buy-side course in business school. Then the section on, for example, on fundamental analysis deals with accounting and valuation. So that's a fourth field. So like that, every chapter has its own field if you go into it in depth. The last chapter, behavioral finance, why we are messed up in our heads, deals with the marriage of psychology and finance, which is a hot new field, behavioral finance. And then the Kohinoor chapter, looking for the ideal stock, deals with competitive strategy, which is again Prahlad and Clayton Christensen and Michael Porter was a familiar name. Actually, there's nothing called competitive strategy. The field is applied industrial organization. It's a sort of IO is a whole field. So the challenge, like you can see, is to marry the Dalrymple Pillai sort of historical approach with detailed knowledge of the markets chapter-wise. So it was not easy. It's a methodological challenge.
So since you mentioned battles and kings, I'll skip a couple of technical questions and get to battles and kings in the financial markets. Of course, everyone here probably knows about Harshad Mehta. I don't know what sort of king he was, but whatever he was a known figure. Some of you will know about Ketan Parekh. But do you want to tell us about some of the kings from the antiquity of the Indian stock markets? You know, names like Premchand, Roychand and stuff that many people may not even have heard of. So,
Premchand, I call these people the dervishes of Dalal Street, the big professional traders. And the dervishes of Dalal Street. And Premchand Roychand was the first dervish. And then the record falls silent for 150 years. And so today you have Rakesh Jhunjhunwala and Radha Kishan Damani and all. But from Premchand to Damani is 150 years, and there was no dervish. So it is all a little strange. Premchand is an unusual character, a Surti, Shravak Jain, who comes to Bombay before the huge cotton and share mania and develops a practice broking. He initiates a tradition which has been the curse of India's financial markets, which is the principal agent problem. The principal agent problem starts with him. In financial markets, you are either a principal for yourself or you're an agent for someone else. And you don't combine both and never deal with someone who does both. This is a key issue, it's a complex issue. And yet, the broking class in India and Bombay, because of Roychand, they develop a strange tradition of combining acting for themselves and acting for others. You never do that in finance. You do your own stuff, you trade your own book, Morgan Stanley and all. I think you're out if they find you speculating on the side, right? So HSBC also. So you do your own stuff or you do stuff for a client, but that's called a principal agent problem. So you see it in its earliest manifestation in Roychand. It's a severe practical problem. But he's an operator, he's a wheeler dealer. His great ability is the ability to take winning and losing with the same phlegm, with no real difference.
Sorry, I have to say I had to look up phlegm in this context while I was coughing a little bit. Yeah.
A phlegm is indifference in this context. Whether he was up something or down something, he never really cared. It was and that allowed for a certain calm decisiveness in trading. You understand, because trading, it messes up your mind big time, winning and losing large sums. So Roychand had this ability to completely ignore when he was winning and losing. And he also had a remarkable ability to deal with human possibilities. Whereas India, sometimes we focus too much on human limitations. So Roychand had this ability to move the crowd, the mob, in a direction which made them aware of human possibilities, not human limitations, which is why he was a noted pipe piper. You know, the pipe piper of Hamelin, Roychand was a very good pipe piper like that. So, and he may have gone bankrupt, but he hid it. And, he did his own stuff, and he built Rajabai Tower, that whole Bombay University star. And so there was an attempt to curry favor and come back by doing good deeds. Strategic philanthropy, right? Something like that. Tatars do that today also. But he was one of the first.
Not just the Tatas, the robber barons at every phase of every market.
They have done it, yeah. So they sort of do good deeds and stuff like that to compensate for Dostoevsky, behind every great fortune there's a crime. I don't agree with that. But they do it. They do. So Roychand is like that, basically.
So just to give you time context for that, Roychand was vintage 1855, 1860, about 20 years before the launch of the Bombay Stock Exchange. So lots of history about these kind of people in the book. So for those of you who are interested in both stock markets and history that predates the formal stock exchange, there's a lot of information in there.
Roychand, the life is a failure before 1860 and an anticlimax after 1865. So you understand. So he comes into the books in that period, which I cover. The cotton and share mania. It's a huge thing. So
yeah. So there are a lot of technical sections in the book. Again, for those who can, please read them because it is very comprehensive and lays out in one place what you might think about portfolio theory, how the NSE's plumbing is organized, and so on. But it's not necessarily for a very heterogeneous audience of the type that we have here. I would just ask you to speak about, you have a chapter there on speculation and investment, Adil. So just tell us a little bit about how you reconcile these two things and the fact that today the Indian market, for those of you who don't know, is about 95% speculation, and measurably so.
Speculation is decision making only on the basis of price action, not dividend receipts or valuation. And using what you know to make an estimate about a single future state of nature, which is the behavior of price. That's all. So it is only price that matters to the speculator, whereas investment is a more reasoned approach where you try to arrive at a value for the asset and you receive dividends. Dividends are very important over the long term, by the way, and they get hidden. By and large, India is a very, very speculative market. But the great danger is with the public is that they are speculating without even knowing they are speculating. So that is something to take out of this, that you have to know what you're doing in terms of method, speculation. Because brokers are very keen on, brokers only care about churn, turnover. They want you have to move inventory. They keep churning the portfolio because they make 0.25% that way. So, but you don't want that because every revenue for the broker is expensive from your account and your equity. So you have to be a little careful about indulging in speculation without even knowing you are doing it. So technical analysis, charting and stuff. People look at charts and all that. So that is always speculation, basically. So the broker markets it to you as speculation, as technical analysis, but it's actually speculation. And then small cap stocks, micro cap stocks, right? They are not investment grade. So you buy them, that's an inherently speculative activity. If you buy in excess of the capital at hand, you buy Infosys for 1620, you put all your cash on that, that's a trade, an investment. But if you put only 10% and buy Infosys, right, with 10% margin, the leverage is 10 to 1. So, or you use derivatives. So these are all inherently speculative. And the Indian stock market, I've noticed, public, which is you guys, you often end up speculating without knowing it. So that's the big deal, basically. So that's why it's good to know exactly what you are talking about and to call a thing by its exact name. In this business, you call anything by its exact name, it's a great achievement. So that's investment is what Morgan Stanley would do typically, or a big firm. They sort of accumulate large amounts of capital and they are allocated to so many countries and asset classes, and then they bring valuation into play and they look for good companies and they sort of buy and hold. They buy 100 rupees worth of stock with 100 of their capital, and then over the long run they sort of they do well, and that's investment.
Yeah, despite the presence of a very large mutual fund industry now and the growing importance of SIPs, single stock futures in India, the ability to speculate on a single stock still dominates the volume in India. And India is relatively unique. For instance, the US does not have single stocks futures. It has options, but it doesn't have single stocks futures. There are a few other markets. So you want to talk briefly about single stock futures and the fact that a significant amount of the daily volume actually is going through single stock futures rather than through 100 rupees on 100 rupees of investment. It is 10 rupees on 100 rupees of investment. And so all of us collectively are essentially leveraged on the return to the stock market, which is what he's calling speculation.
Infosys, a common well-known Bangalore company, I think it's about 1620 today, 1620, the price. So you take 1620 from your bank account and you buy Infosys, and your bank balance goes down by 1620 and you get one share in your demat account, right? But with the single stock futures, something called leverage comes in. So you buy the 1620 Infosys share, but you put up only 20% as margin. which is 324 rupees. So you're controlling that 1620 share with 324 rupees. That's called leverage. That's how these markets work. That's how derivatives work. And that's how corporate finance often works. So, and the leverage factor here is 5-1 because the Infosys share is 1620 and you're only putting up 324 of your money. So if you make a 5% return on the Infosys share, that's a 25% return on your margin. So you're magnifying, leverage is amplifying returns by the extent of the leverage factor, which is 5-1 here. 20% margin is 5-1. So a lot of derivatives and a lot of speculation takes place on this, where people buy in excess of the capital on hand, which they don't have the 1620, so they have only the 324. So that's, the whole Badla system ran on that, the famous Badla system of the BSE. And now the reform effort of the 91 movement thought they would reduce speculation. Actually, it has catastrophically increased because of the derivative segment and so many other issues. So that's an unlikely side product. So I'd estimate maybe 2 to 3% of people of the volumes are, like I said, you buy 1620 worth of Infosys share with 1620 of your capital. 95 to 97% is trading on margin, speculation, stuff like that.
So before I synthesize the book, let me ask you to think of your questions. In my mind, this is a tour de force. It's very authoritative description of the history of the Indian stock market. Word of caution, though, it is really for practitioners. For those who are not, those interested in history, read the first half. Those interested in the technicality, read the second half. It's tough to get through for the average layperson because there's a lot of detail in it. But that said, it truly is the authoritative. There is no other book as far as I know. And Adil's coming to a literature festival for the first time, Bangalore.
Thanks.
So he was very nervous about what goes on in these things. So here we are.
Bangalore is the city of India's future, I think so, based on this. So I'm very happy to be here with you.
By the way, we did have a stock exchange. We won't have time to talk about it. It's also part of history now.
1963 to 2014, there was a Bangalore Stock Exchange. Yeah. There's a municipal era where stock exchanges were municipal monopolies. So every city had its own exchange. So Bangalore had 63 to 2014.
Okay, on that note, maybe we can take some questions, please.
Yeah, hi. Very engaging conversation. My name is Siddharth. I have some commodities derivatives background. So I've read a bit about it. Is it true that the commodity derivatives even predate stock derivatives, stock market as such in India? Because there used to be a cotton exchange in Mumbai. I think Cotton Green is named after that. Yeah. That's my first part of the question. And the second is that what's your thought on this whole disappearance of regional exchanges? I know that they used to be big boys club and they used to control a lot of things and a lot of manipulation happening. But is it just like general economy? It has elevated to a higher level. For example, the NSE co-location scheme, not scam, I would say. Yeah.
Excellent. Thank you for asking short questions. Please go ahead.
It's a very interesting point because commodity futures predate stock trading. The first mania in India, I call it the cotton and share mania. So there was a cotton displacement and people made money in that, didn't know what to do with that, they moved into shares. So there is a historical pattern in which traders acquire expertise in commodity trading. Badnis, Nazrana, India had options and futures before the West. So, and you're right, traders, that's how the speculative temperament came, because commodity trading is very speculative, and traders migrated and brought that commodity speculation into the stock market. On the regional exchanges, there is a municipal era, and they had their place in the sun, and then SEBI lost patience. It's called regulatory forbearance. It's an ugly term in which SEBI sort of says, let's do it and let's keep these guys going. And then some nameless, faceless bureaucrat loses patience and they're gone. So the regional exchanges, Bhubaneswar, Bangalore, all simply disappeared.
But,
So,
but the origins of the municipal stock exchanges, as Adil calls them, they bifurcated the volumes. So subsequently, worldwide, this bifurcation of volumes is a problem. Co-listing is okay, where the stock is traded on both and you can maybe even arbitrage prices across two indices as it happens between BSE and NSE today. But if you bifurcate volumes, then certain volumes just disappear on you. So the argument against, for instance, creating a small cap exchange is exactly that it actually deviates volume away from main exchanges and doesn't work in the long term.
don't do.
Any more questions? Yeah. Mike, yeah, please.
Yeah, I have a question. I have a question which may seem naive, but I'll ask it anyway. If for a layman who actually doesn't know anything about stock market and only sees it as wealth creation opportunity, so he doesn't know, he doesn't know or doesn't want to know anything about the stock market and simply invests in a basket of stocks or stocks just created by some portfolio managers and fund managers. So what is your take, or what is your opinion rather, on people, lay people, just investing in a basket of stocks without knowing anything about CAGR, anything? Just they put some money
Got
in
it. Got the question, yeah.
Yeah.
Go ahead.
My sense is, no, that's not a naive question. It's not a naive question. It's a very good question. A lot of people do that. They are called index funds. They just select the 30 stocks that make up a Sensex or a Nifty, and they bung it in there. And then the portfolio manager's job is to track the index. It's called tracking error. Sometimes it's a mess, basically, because they're very small fractions. And with large sums, you have to track it carefully. But you're right. So without thinking in the least, they have bought and got exposure to a basket of stocks. And it's not naive. It's $1 trillion business. So it's not naive. It's a lot of people do that, basically. So Vanguard. It's an index fund.
I might just say that, again, with the usual caveat of past returns are not indicative of the future, the last 30 years, if you break it up in any 10-year sort of segment, the Indian stock market has returned 14% nominal in rupee terms and about 9% or 10% in dollar terms. And so from the point of view of alternatives, it has not been bad. And therefore, if you broadly believe that the Indian economy and Indian earnings will continue in some positive direction, then it is it's not bad as one segment of your money.
Gentlemen, Umesh here, you talked
may I
about
ask the
Bangalore
question?
being the
I
future.
think you want to ask.
So, what about the onset of algo trading? Is it covered in that, using AI? Is it also speculation? Is it the future, completely game changer? What are your views on that?
These statistical arbitrage, algo trading, these are very mathematic intensive areas which don't belong in a general interest book like this. It is happening. I don't know the exact extent. Black boxes and, hedge funds do a lot of this. Jane Street, Jane Street, they were slapped with a fine of thousands of crores just for getting their trades right. That's all, Jane. It's not a crime, if you ask me. They're just doing it. So certainly, but you would need a command over a fair amount of mathematics, and you would need very good execution, trade skills, transaction costs. You'd need to make sure your broker and you are in perfect agreement that transaction costs are low, because you're buying and selling millions of times a day. So it's called the vigorish. You'll end up making your broker rich if you're not careful. But the hedge funds, they have their own people, prime brokerage, etc. But it's not a small person's game. It's very secretive. So even if you're making money in a certain way, you're not going to tell the world about it. Right. So you'll keep it to yourself. So it's a very secretive world. Certainly it happens. Quant cowboys, quant jocks as they are called. And so they do it. And the NSE tried to give them data without telling other people. And somebody's relative was on the... It was a tangle, basically.
I have a question.
Literally last one, we are on 7 seconds. So you can do an algo trade.
Very fast. If India is India is the oldest emerging market since the last 2 centuries, when is the Indian market going to emerge?
With the Indian market?
No. Okay, so please read the book. Indian market has emerged in many ways. Most particularly for those of you who are thinking about how India competes with China and so on. The plumbing of the NSC is one of the few places where India is ahead of China. So it has emerged in some ways, and it will emerge in other ways. So you... One minute or less, 30-second answer.
Just a last one.
Yes.
Just a last one, yeah. So myself, Vaibhav from Mumbai. Just a minute. It would be a very short. So I'm myself working in a broking...
You're trading after market hours.
No, sorry. So I'm myself working in a broking firm, okay? So there are a lot of new traders and investors here out there. So a lot of people are fancied about small cap and mid cap. So as per your experience, I want to keep it short. How you think so people shall deal with small cap and mid cap for next 5 to 10 years? Because a lot of people have earned a lot in last 5 years, you are also aware. So can you just guide everyone? It will be very helpful.
I don't give financial advice.
You can just give a pattern to solve it.
But it's a risk-return trade-off, and they are very risky, and you need to be compensated for that risk by a higher return. So that's
Thank you very much. The person from SEBI will speak.